Welcome back to the show. Today, I'm joined by Marcos Segrera, Principal and Wealth Manager at Evensky Katz Wealth Management. Marcos works closely with individuals and families to help them make thoughtful financial decisions. But what really stood out to me about this background is the emphasis on behavioral finance, not just the numbers, but how people actually think, react, and make decisions around money. Marcos, welcome. Glad to have you here.
Thank you very much, Mark. I'm very happy to be here. Excited to chat.
Excellent. And Marcos, I always like to start with how people entered this profession, because most careers in wealth management are not accidental. Walk us back to the beginning and what originally pulled you into wealth management. What made you decide this was the field you wanted to stay in?
So this is about 17 years in the Wayback Machine. And what I found myself doing at the time was becoming a father much sooner than anticipated. So I'm very proud to share my why, Mark. I think it's been something that's helped me a lot in my path. It helped me take ownership of it very quickly. And function, what happened is I was a senior in high school when I found out that I was going to be a dad my freshman year of college. And when that dawned upon me and we made the decision, we're having a kid, just to be frank, I had no idea what to do with the next dollar going into my bank account, right? I didn't know what anything was. I didn't know what insurance was or how it worked. I just know these things existed. And so I took it upon myself to give myself a little bit of a crash course and personal kind of education. And that ended up, it was probably 12 months all in, right, with kind of varying degrees of intensity. And as I did that, I found myself saying, I feel like this is unnecessarily complicated, and I think I can do this better than other people can. And it had nothing to do with my IQ, and it had everything to do with my ability to be probably a little bit above average, disciplined and organized over kind of the next person. So that's really what launched me into the career, was kind of my own personal financial planning journey, and me realizing that temperament was a lot more important than IQ early on.
Excellent. Great story. And Marcos, was there a moment when you realized this profession was less about math and more about the people?
Yeah, when I found myself being successful in it, I knew it wasn't all about the math. Look, so I think everybody who works on the personal wealth side, so the wealth management side, where you're not just given a pot of money to manage, I think those folks quickly realize it's a lot more about understanding someone's or a family's or a business owner's or whomever you kind of want to qualify, and understanding their relationship with money more than it is what the S&P 500 is doing or how much life insurance you have. Because you end up realizing that you have to separate between kind of the tools that are there to get things done and what's really important to people. And once you get better at having those important conversations and teasing them out of people, you get better at this gig.
Absolutely. You know, one thing that stood out to me when reviewing your background is the emphasis on behavioral finance. That idea that financial planning is just not about spreadsheets. It's about understanding the human behavior. And from your perspective, how much of financial success actually comes down to behavior rather than technical strategy?
I think a large majority, over 50%. And the reason I say over 50% and not 99% is because some people might get offended if I said 99. But above 50%, 99 is still in there, right? And I would equate it to this: when you get into shape, a lot of the personal trainers would tell you it's kind of 80% eating, 20% all the heavy lifting and things like that. And I'd tell you your behavior is kind of the same thing. It's the biggest lever that you can push or pull, assuming you have kind of a baseline understanding of your personal finances and some path to kind of guide you and course correct to and from, because financial planning is really a lot more about adaptability than it is kind of intelligence seeking and brilliance seeking.
Yes. And what are the most common behavioral mistakes you see investors make?
I'm going to take a step back and kind of give you one number that I always think is shocking, because if you follow folks who are in the behavioral finance space, folks like Brian Portnoy or Daniel Crosby or the late Danny Kahneman, and Danny Kahneman spent kind of a lifetime identifying what is it, about 189 cognitive biases that make us all terrible at dealing with our money. All of those things are basically humans pointing at other humans saying you're stupid when it comes to making decisions when money's involved and risk is involved. The problem is that hasn't been all that useful, right? Kind of just pointing the finger and saying you're not good enough is just kind of not productive. And then I'll bring up another person anyone who has interest in the kind of the behavioral finance world would do themselves a favor in reading more on and about is Richard Thaler, who basically makes a point that it's not that we're dumb, it's that the world is hard.
Hmm.
And a lot of these behaviors come up simply because our brains haven't been updated in a long time, and we are ultimately just kind of beings who think, right? And beings who feel. Except the reality is we feel before we think, which gets us into trouble in 2026. But back in the year 26, it helped you avoid the saber-toothed tiger type thing. So I think the biggest behavioral bias that folks anchor on a little bit too much, it's this idea of capturing whatever index is kind of popular du jour. Today we can use anything like the NASDAQ or NVIDIA or these kind of high-flying tech stocks and taking their own personal financial plan or story and saying, well, if I'm not doing that, then I must be doing something wrong. I need to make sure that I'm capturing those things. When the reality is, you do not need to time markets perfectly to be able to get to great outcomes. You need to be able to do the average thing while most people find it very troubling and hard to do the average thing. And then that goes back to behavior. So while it's fun to talk about catching the next NVIDIA or kind of your tech stock du jour or whatever the hell it is at the time, it's wholly unnecessary as far as trying to get to a thoughtful, positive, good financial outcome.
Right, right. And one thing you mentioned in our earlier conversation that really stuck with me is you pointed out that in wealth management, referrals are not just part of growth, they are often the majority of growth. And that is very honest and a grounded observation. So, from your vantage point, why are referrals still the dominant growth driver in wealth management firms?
So I think, and this is, by the way, a stat across the entire profession that exists for every single firm, from the largest to the smallest, referrals make up over 80% of the new business that wealth management firms capture. And I think the easiest, obvious answer is trust is the most important item that an advisor carries with them. And when you build that trust with an individual or a family, that's what creates the confidence to be able to, hey, make an introduction. Sales always gets a little bit of kind of this dirty connotation to it. Sales is really just a transfer of confidence and ultimately a transfer of trust. So the best advisors are generating the most of their business from referrals because they're great at building trust. And you need that in order to operate in what is a very sensitive place, which is kind of this harmonizing of your hard-earned dollars and all the things you want to have happen, and just as important, the things that you want to avoid. So I think referrals will forever be the number one source of business because trust translates.
Absolutely. And I agree with you on the importance of trust. And this is where the conversation gets interesting. Not replacing referrals, but strengthening growth around them. From what you see in the industry, what other factors support growth alongside referrals? For examples, visibility, thought leadership, digital presence, educational content. Which of those actually matter in your experience?
Yeah, so that I like how you framed it with the different kind of items of visibility, thought leadership, communication, reputation, things like that. I think all of those are a requirement, especially as you grow as a firm. We're a 40-year-old firm. We manage just shy of $4 billion. But I will tell you that we've spent a lot of time over the past 2 years, especially 3 years all in, kind of getting more in tune and fine tuned around the education that we provide the market and our clients. And I think in 2026, when obviously the tools of and your LLM of choice or just a quick Google search, all the information is available to you. The distillation, right, is where kind of the magic happens. And I will kind of quantify two things here. There's in this world of AI, I think there's an impact differently if you're a mechanic versus a guide. We put ourselves by definition in the guide position. And what we've done from kind of a branding education perspective is we've had all of our advisors with the lead of our director of marketing, Michelle Panzera, choose a niche that speaks to a specific audience. We lean into that niche because each of the advisors has a special attachment to that niche. And then what we will do is we'll bring in centers of influence, other trusted professionals, other guides, so to speak, and we'll collaborate on content with them and bring that education to market. And since we're trying to speak to a very specific audience that almost fits on the end of a pin, it resonates more. And we're seeing a lot of traction there.
Excellent. Excellent. And do you feel clients today research advisors differently than they used to?
Absolutely. I met with a client yesterday. We had our final kind of presentation meeting where we gave a planning and investment recommendation. They found us on ChatGPT, and that was probably the second time that's happened to us. So number one, 1,000%, folks are finding us differently because let's go back to your referral point. When Mark asked his buddy, who's a successful professional, hey, I'm kind of thinking about this, that, and the other. Say, Mark, you got to talk to my wealth management advisor X. What's the next thing that you do? You're going to Google them, right? You're going to Google them,
Yeah.
whether you like it or not. Anyone likes to admit it. So how important is a website? It's important enough to say you shouldn't have a bad one. Do you need to have the best one with the most bells and whistles? Probably not. But you don't want someone to land there and find this is antiquated. This just feels like it doesn't resonate. So that's kind of step number one. Step number two is how specific can you make your content so you can speak to the right people? And I think one thing that happens as you're in this business longer and longer is you realize that you just don't want clients that can fog a mirror. You want clients who you can provide value to, because those are the ones who stick around. Those are the ones who can stick to a plan that you built for them when the going gets tough. So for us, that's been incredibly impactful to make sure that we're trying to move with the cheese, because yes, the reality is everyone's researching their advisors differently. I think word of mouth has stayed, but you can't help it, and you can't deny the fact that everyone is Googling you or chat GPTing you, or again, pick your LLM of choice.
Absolutely. And Marcos, let's go back to trust and unpack that a little.
Yeah.
Trust seems to be at the center of everything in wealth management. Once trust is built, relationships often last decades. What damages trust faster than people realize?
There's something that I probably didn't invent this, but folks in the office will probably say I did, because I'm just an amalgamation of all the things I have read in my life, that I'm lucky to have read. I refer to it, I should say, as kind of a say-do gap. So I think the number one thing that fractures trust, sometimes quickly, sometimes slowly, is any space that exists between what you say you're going to do and deliver versus what you do. And it's something as simple as having a conversation with someone and mentioning a book that came to mind that you're going to share with them. Share the book. Do the thing that you said. And that behavior in and of itself will separate you from other folks that consider themselves trusted advisors. So as simple as that. I think a say-do gap can fracture trust materially.
I agree. And what separates good advisors from great advisors?
So I think this is something I'll die on. I think everybody, or call it 8 out of 10 people, want to know how much you care, and they want to know how much you know, and in that order. And I think if you can create that relationship honestly, with respect, because you care about the whole person, you're caring more about purpose as opposed to goals per se. You want trust and relational depth, right? So trust over transactions, conversations over concepts. I think that comes across to your client, your prospective client, as this person wants to connect with me so that they can help improve my decision making, and they can help improve how I interface with money. And that translates to a person, because most people will tell you the most important thing to them is their family. If you go through enough layers of why, and you go through enough layers of tell me what about money is important to you, most folks get to family at some end, right? Not wanting to let them down, wanting safety and security. And when you can build trust, they feel like you're not just doing something for them, but you're doing something that they can count on generationally.
And I agree. And Marcos, the financial landscape is evolving quickly.
Yeah.
Technology is advancing. Clients have more information than ever before. What changes are you seeing in client expectations compared to 10 years ago?
It's hard for me not to say the thing that everybody knows, which is just how available you are. I think there's an expectation because of how easy everyone is to reach, that you will be available. So I think that's kind of an obvious one that I can't avoid saying. The other item that I will say, and this is probably 40 years in the making, is there's been a lot of kind of supposed headline pressure on the idealistic 1%. And let me kind of unpack that a little bit. 1% is what's usually referred to by the market as what an advisor charges to work with a client, kind of 1% of the portfolio that's managed. And there's been a lot of quote unquote kind of pressure on this 1%, especially over the past 5 years, definitely over the last 10 years. And what you've seen is there really hasn't been nominal pressure, so to speak, on the 1%. You haven't seen that 1% actually come down. What you've actually seen is an increase in services or available expertise for the same price, right? So folks expect more for the same price that they've been paying for the past 40 years. So that's to say, when a client who's 70 years old comes to me with a estate planning, generational planning question, they want me to be prepared for that. They want the team to be prepared for that, but they also want you to be prepared to answer the question about helping their grandson make a decision about what car he should buy or lease, right?
Hmm.
What insurance policy should I or should I not purchase? So I think the scope of what your trusted advisor has their hands in or is able to give you advice on has expanded. So another way to put it, perhaps the Overton window has expanded for the trusted advisor role.
Okay. And here's a question. Has access to information helped or complicated decision making?
Good question. I have a specific opinion on here, and I'll take the helped environment. I think a certain level of education is always very helpful. There is kind of that fine line. If you start knowing too much, you start making your own prescriptions, so to speak, too much WebMDing type thing. But I actually have preferred the abundance of information because it creates more engagement. And here's the thing about money and why it becomes, I think it's a reason why it's challenging to do the whole money thing well, because it's taboo to talk about. It's been
Hmm.
taboo to talk about for how long, right? Kind of since the beginning of it, right? And when something is taboo and not openly discussed, especially in a family setting, but definitely amongst your advisors and especially among spouses, it's hard to address issues. And then what happens? Those issues go unaddressed and they build resentment in some fashion over time, and then you get to a bad outcome. So this overabundance of information that I think is more apparent in kind of your younger generations, 45 and younger, over 45 and over, has created more collisions to have conversations about money. And I forgot who said this, but kind of you're in constant interface with money. There's what do fish know of water, so to speak? It's kind of a similar thing I'd take with what do humans know of money? You're in constant interface with it. So you better kind of address your relationship with it and perhaps your family's relationship with it also.
Okay. That's great. And Marcos, how do firms maintain credibility in a crowded marketplace?
I'm going to go back to what I said before. The marketplace is crowded for certain, but I will tell you that the majority of managed money still sits on bank balance sheets. And again, nothing wrong with the Morgan Stanleys and Merrill Lynch of the world or the Wirehouse of the world. But the reason they are the largest is because they've been around the longest. They have the most free cash flow and they've been able to invest in distribution. Trajectory wise, what you see is more people want to go to the independent chef, right? Not to the wholesaler to be able to get independent advice that is in their best interest. So that's kind of number one in differentiating this kind of registered investment advisor world versus kind of the older school large bank world. The large banks still have their place, to be frank. There are many things that they do that we do not do. So again, not bad mouthing them whatsoever. I think the ecosystem needs both. But as it relates to the people and the humans, they're coming to the RIA market because they want that unbiased, uncompromised advice. And then within that market, if I'm now forgetting about the larger banks and I'm just operating this world of RIAs, yes, it's saturated. Go to all of our websites. It all says the same stuff. What we're trying to do to not sound like everybody else is do what I mentioned to you before, which is simply stated, find that niche that fits on the end of a pin and speak to it, educate them, talk to the issues they're facing, help them make decisions without you there. Because what ultimately will happen is you'll build this trust because they will see you as a source of truth. And then ultimately, most people like to be thoughtful delegators, especially successful ones, which is frankly who we're usually working with. So that successful, thoughtful delegator is eventually going to need a home for who they're going to trust with their hard-earned wealth and the wealth they want to pass on to the next generation. So we're trying to find as best we can that kind of, again, end of a needle, yet has fixated on that profile as possible across the advisors on the team and speak to them directly.
I love the focus and the clarity you're speaking about, and that's perfect. And looking forward over the next few years, what trends do you believe will shape how wealth management firms grow?
I'm going to speak to one because I have a big take on this. I think the registered investment advisor space is going to under-hire advisors over the next 5 to 10 years because they think AI and other platforms and technologies are going to let them hire less. And I think, like any other item that gets less costly, right? The next unit of production is going to cost less, will mean there's going to be a greater demand for it. So I think you will need more humans to deliver advice over the next 10 years than you did over the previous 10 years. And I think the firms who overhire, perhaps, or at least definitely don't underhire or deprioritize hiring and talent, will be successful and better positioned to grow. And I think a question leaders of registered investment advisors should be asking is, how human is your human capital? Because I think so from today moving forward, the ability to engage with EQ, not just IQ, is what's going to separate the great advisors from the good advisors over the next 10 years.
Perfect. So, Marcos, this has been a great conversation, and I really appreciate you sharing your perspective. For listeners who want to learn more about you, how should they connect and reach out to you?
I appreciate it. So the best way to do it is, of course, there's a LinkedIn profile there, but on our website, evensky.com, you can subscribe to all my posts, all my blog posts. If you don't like my niche, which tends to be behavioral in nature, I have plenty of other advisors who have different niches as well. But LinkedIn, our YouTube channel, you can find us at evenskyandkatz.com or just evensky.com.
Perfect. And for our listeners, I will be putting Marcos's contact information and his organization's contact information in the description below. Marcos, thanks again for joining.
Mark, this was excellent. I appreciate it. Thank you.